Hello, it's Jordan. This video is being recorded on the afternoon of Thursday, April 20th, 2023. Thank you so much for joining me today. Now, in this video, I'm going to talk about why the gold stocks are just beginning what I think is going to be an epic secular bull market. They are about to enter into something that we have not seen since the early 2000s, early to mid 1960s, et cetera, et cetera. And this is interesting because the sentiment, and I talked about this, we talked about this, me and Gary Tanashian in his interview, the sentiment on gold stocks is still terrible. I've made the comment, we've come to the point where based on the last 10 to 15 years, everybody knows that gold stocks are terrible, period. Perfect. That's the perfect setup for a secular bull market, given what gold is about to do. So let me get into it. Now, the first thing I want to talk about is go back over the last 2.5 years and do a little math here so we can understand why, when there's a correction or a cyclical bear market, why gold stocks and juniors fall 50%, 60, 70%. And so, I mean, people, this is not that difficult to understand when you understand the math. So I'm giving some examples here. These aren't special examples. You don't have to be a genius to understand this. But I'm trying to explain here why gold stocks are down 50 to 70% when the gold price is only down a little bit. And the main reason is that the cost went up a lot. And, you've seen this at various points in the last decade or so. I mean, after 2016, after 2018, 2019, 2017, and that you get these corrections in gold stocks. What happens is you have a correction in gold and the mining costs also go up at the same time. So the companies get squeezed on both sides. And this is what has happened generally in the last decade, where if you go back to 2011, 1900, 1800 gold price in 2012, look where we are now. I mean, the costs of mining are much higher than they were 10 years ago, whereas the top line hasn't changed that much. And so in the numbers here, let's go back to around the time gold bottomed, the middle of 22 or the third quarter of 2022 and that sort of thing. So think about the average producer around the 2020 peak, before inflation really kicked off. Let's just think of an average mine. So let's say their all-in cost is $1,000 an ounce. Not bad, half decent at that point in time. So their margin on that mine is $1,000 per ounce. Well, the same mine, if you go 2.5 years forward, or 2.5 years, 2+ years, and I won't use the bottom at 1630 or 1640 gold, but let's just say gold came down a little bit to 1800. The costs in that 2.5 years definitely increased quite a bit. I mean, inflation really kicked in after the summer of 2020. And so if you look at the numbers, that's just one average. Again, you don't have to be a genius to understand this. That's one scenario where cost goes up 30%, 2.5 years, gold price is down a little bit, boom. That's how your margin there is down 50%. And that's why the gold stocks divided by gold, that's another reason why that ratio falls into the toilet when gold is not going up and costs are going up and gold's not in a secular bull. Now, let's look at juniors. And again, this is another just a basic example. I'm just taking numbers here. Let's say a junior, explorer developer, they have a project. And so at that 2020 peak, let's say the net present value, whether they have a study or not, let's just think about it and assess, okay, it's $500 million is the net present value at that point in time. So at a valuation of 0.2 times net present value, it's $100 million market cap, plus cash. So the company's worth 107, 110, whatever. So the asset's worth $100 million. Well, what happens in 2.5 years when the gold price is down and you throw in cost increases? Maybe the valuation goes down a little bit, and then the net present value, based on the higher costs and the worse margins and the gold price is down, that all comes down. And so, I'm just pulling out numbers. It's probably worse for these companies than what I gave in this example. That's how much the values come down. And in addition, What I'm not factoring into either example is this is over a 2.5 year period. It's not factoring in dilution. Most of these companies, even producers who aren't that strong, have to raise money. I mean, even strong producers will do an equity raise every few years, when the time is right. So, especially at the bottom, that company is, if you look at most juniors, smaller juniors, let's say the ones that are under a 800 or 700 million market cap, how much dilution have they had in the last 2.5 years? I mean, that's probably, I don't know, 15, 20, 25%, probably depends on the stock. But you factor that in, that's why they are down so much off the high when gold is only down a little bit. And so in this chart here, I have gold against the S&P at the top, then gold against the CPI, gold stocks against gold, then at the very bottom, gold stocks. So the gold stocks is the Barron's Gold Mining Index, and that goes back to 1938. Nick Laird from Gold Charts R Us gave me some data, which I can attach to it. And that's what I did, going from 1926 to 1938, 1939. So that's how I came up with that. And you can buy the gold stock data from him for $20. So great website. That's goldchartsrs.com. So, there's a couple of main points here with respect to the gold stocks, because I know I'll babble on forever. But gold stocks do really well when the gold price is rising in real terms. That means it's basically outperforming other assets, and therefore it's outperforming costs, and margins are going up. That's when gold stocks outperform gold. We just showed you why recently they haven't been going up, and why they've been losing relative to gold, why those ratios have fallen into the toilet. And so typically, when are gold stocks doing really well in real terms? Or when is gold doing really well in real terms? When gold is in a secular bull market. So look at the highlights here. We know that gold was in a secular bull in the 1970s and in the 2000s. And look at how well gold was rising in real terms. It was outperforming the CPI, outperforming the stock market. The same thing happened in the early 1930s. Now, gold against the CPI, don't have that data, but it looks very much like gold against the S&P. So those three secular periods, you had the gold prices going up, and it was in a secular bull because it was it was going up so much that it was outperforming costs, outperforming other assets. And so that's what I think we're about to see the beginning of over the coming months and coming quarters. Gold getting ready. It's a hair or two away from breaking out of this super bullish cup and handle pattern that I've talked about. So what happens if, I'm right and gold's going to double in the next 2.5 years and go to 4,000, and then maybe even 5,000 in 3 years? That's a new secular bull market. And based on that kind of a move, gold is going to be dramatically outperforming in real terms, even if the costs start to rise a little bit. And I mean, at some point, 2, 3, 4 years, whenever, you'll see, this will happen periodically in the secular bull. You will see costs will start to go up, gold will slow down, and that's when the gold stocks will get hit and maybe have a cyclical bear or a deep correction. But we're heading into cyclically the opposite of that, where gold is about to make this huge move higher, and it's going to be dramatically outperforming other asset classes and therefore mining costs. Margins will really expand, and the gold stocks will rebound and really outperform gold. Boom. That's the new secular bull in gold stocks. And last thing, look at the bottom there. I like to keep these videos under 10 minutes, but this one's going to go over. Look at the very bottom. That was one of the biggest breakouts in history. Gold stocks, 1963, 4, however you look at it. That was a breakout of like a 26, 28-year base. Beautiful base. That gave way to a spectacular bull market in gold stocks until 1980. I think we could be setting up for something similar. And the Barron's Gold Mining Index is trading right now. It's, not that far off from the price 42 years ago. If you go back to the mid 60s, it was, 64 there, 1930, 20, same price as 28 years ago. So the gold stocks are even more, I guess you could say, oversold or cheap relative to other classes historically than they were there in the early to mid 60s, right before they had that hugely significant breakout. I mean, that was a multi-decade breakout. And if you look at the two arrows, I think we're going to see something very similar. And you're going to see gold stocks. If gold's in a secular bull market the next decade and it goes to 10,000, 12, 15,000, you're going to see gold stocks make the same move like they did in the 60s and 70s. It's a new secular bull market. They're set up to make a spectacular move and a spectacular breakout move sometime in the next 12 months. So all of that is why we are going to see a dramatic sea change for the gold stocks. And it's going to start, it may have already started, but it'll really kick in when we see gold break out here above 2,100 and run to 3,000. You will see significant leverage in the gold stocks because there's not going to be that many cost increases over the next 12, 15 months, given where the economy is going. Now, eventually, 2025, you'll probably start to see costs increase a little bit, but gold will still outpace it. But nevertheless, that's all for this video. I know that gold stocks have been terrible for a long time, but they're ready for a new secular bull market. Thank you for tuning in. Let me know what you think in the comments. Talk to you guys again in the next video.